To introduce my old friend. I won't say how old either you are
I'm
or
66.
I am. I'm 61.
I'm not old, I'm
and
37.
we've known each other a long time.
Yeah.
Formed at Barra way back when, and Jeremy's done a lot of interesting things, including having his own fund for many, many years,
Yeah.
working with a lot of fascinating people, and is now collaborating with another, Athena, who I get to work with at Imperial also. So this is this about that paper that
Yes.
published in Journal of Investing?
Journal
of Wealth Management?
Journal something.
One
Journal
of those journals.
Wealth Management.
Institutional Investor Journal, and the topic is Investing for Impact. So take it away.
All right. So, yeah, I'll just give you some slight background here. So I got my PhD here at Berkeley in OR/finance. I was in the OR department, but I wrote my dissertation with Mark Rubenstein in options pricing way back when. And then I was at Barra at the time I was doing that, and as one of the consultants back in the very early days of Barra. And then I was at what used to be Wells Fargo Investment Advisors, which became Wells Rico, which then became BGI, which then became BlackRock. And then I left in 1990 and set up both a software firm and a hedge fund. Well, the hedge fund was a couple of years later. And we were doing mostly statistical arbitrage when nobody even knew what that was really, back in the early 90s. And I sold out of a software firm, thank God, in 2003. And it actually went under in 2001, so I got out at the right time. And then I continued to run the hedge fund until 2011, and we then we lost a lot of assets under management. We had a bad year in 2010, and the market was in no mood for any kind of bad returns at all. And so even though it was only our second negative year in 19, it was enough to drive away all of the assets. So I shut that down, and since then I've just been doing consulting, and one of the things I do is working with Athena, a firm that was founded...
This just looks scary. I don't think we want to do the update now,
No,
so
no.
we'll try and tell Apple to go away.
But the question is, I don't know.
Quit.
Tell it to get lost. That little X over
No,
there
quit
was quite
at the
promising.
Bottom center, quit. Right, keep down, yeah, there.
Oh, that's another good idea.
Well, dodged. So Athena's a wealth management firm that was started by Lizette Cooper about 20 years ago now. And Lizette was a geochemist at Harvard who quit in 1988 and went to the dark side and joined Merrill Lynch. And then opened up her own firm in the 90s, late 90s. And they've gotten very interested in the last few years in impact investing. It's becoming a theme, I think in large part perhaps because there's a generation now of wealthier people that have made their money, let's say in tech, who have more of a social conscience perhaps than people who made their money at Goldman Sachs, who fall into a category that I'll name later. And also, of course, you know, there's a lot more stuff bubbling up about social issues that we face. I mean, to be fair, 20 years ago, nobody really thought about green investing, or nobody really even thought about, gee, do we want to fight third world poverty, or have more women on boards, and things like that. And partly because of more communication, social media, changing consciousness, and so on, it's become much more of an issue. People want to try to do, you know, to do good while doing well. So they'd like to earn money, but they would like to do it by investing their money in places that they think will provide for some social good. So there are lots of different approaches into this. You know, you'll have things like the Catholic Church has a set of values, principles that they believe you should adhere to. And so there are people and institutions that want to adhere to the Catholic values, Islamist values, Jewish ones. You have things like microfinance, venture philanthropy, all these different areas that in one way or another can be thought of as the intersection of a desire to do have some kind of social impact with investing. So this started, at least from my early days. I remember back in the 80s when I was at Wells, the whole issue of divesting from South Africa came in. And I remember going up to Cal Pers to talk about that. Cal Pers was one of the leaders in saying, no, we do not want to do business with people investing in South Africa. So it started out with these negative screens, things on which it is not okay to invest, right? Just, they're out. And that's kind of the first level. And then people started looking at these so-called ESG factors, environmental, social governance issues, which was about more than just ruling out things that you didn't want to invest, in which you did not want to invest. And finally, you get down to kind of the real impact investing. How do I invest in such a way that, yes, I can earn a return, but I can also have some kind of social impact? Now, Lizette put together this timeline that goes all the way back to John Wesley, and I suspect actually it goes back even further than that. I suspect that, probably the Greeks were talking about this. And there are certainly things in the Talmud that relate to this, so it's pretty ancient. And then in the 1920s, the Pioneer Fund had the first mutual fund that screened for alcohol and tobacco. Not firearms, apparently, that would be un-American. But alcohol and tobacco, right? Well, that seems kind of un-American too.
Yeah.
But maybe not. And then, you had more funds that came in, the Pax World funds in the 70s. The Sullivan Principles, I remember that, Reverend Sullivan, and
So my memory of that's slightly different. But, I thought the Sullivan Principles were perceived by the supporters of divestment as an excuse for companies to continue to operate in South Africa as long as they didn't do especially bad things.
It might have been exploited like that.
Yeah.
Of course, I wasn't in this field at all in 1977. I was just come to Berkeley to do a PhD in OR. But, people seem to cite that as one of the milestones, if you like, in this whole progress of social investing. I wouldn't be surprised if it was misused, and maybe he even intended it like that. I don't know. I don't know enough about Sullivan himself.
Who did you work with in IOR?
Sorry?
Who was your advisor in IOR?
Well, I started out with Stuart Dreyfus,
Uh-huh.
but then I got offered this job at Barra working with Mark Rubenstein, so I just switched, and he was my...
You worked with Mark?
Yeah.
Oh, wow.
Yeah. He was a great dissertation advisor. Anyway, there's been this kind of progression, and if you just look at the number of people who've signed on to the Principles for Responsible Investing, you can see that it's just kind of growing almost exponentially. You've got to be careful, there's double counting here, because you may have the owners of capital subscribing to this, and then they put their money with the manager, and the manager also subscribe to this. So it's, the numbers I would take with a grain of salt. It's more just the general shape of this thing that this is really becoming kind of an issue. And what that means is they're actually now, we're used to thinking of investing in the two dimensions of reward and risk. I actually don't like return, I rather reward. Where reward has always meant expected return. In other words, the first moment of the return distribution, and risk is the second moment of the return distribution. But now there's this other dimension that starts creeping in, which is social impact by some measure. So the question is, how do we incorporate this into some of the standard approaches to finance, and how would you trade off social return for financial return? How do you deal with the fact that different aspects of social return are differentially important to different people, right? One person might say it's all about green energy, and another person might say, I don't care about that, I care about poverty in the third world. And so two companies that might look equally attractive in some abstract sense could have very different attractiveness to investors. So we got together, and Lizette had explained the kind of direction she was thinking of going, and I suddenly realized that we could actually derive a very nice result from that. And so we worked on that together. The idea is going to be to try to incorporate social metrics into the standard mean variance framework CAPM. And in the classic CAPM, your utility is, or the reward you get is just purely financial reward, it's expected return. risk-adjusted expected return, of course, and then it's full utility. So here's an example of two different companies where company A maybe scores very high when it comes to environment, education, healthcare, but not very good on economic development, whereas company B scores low on environment and education, medium in healthcare, and very highly when it comes to economic development. So if the investor preferences are like that, very high for economic development, but doesn't really care much about the other three, he's going to prefer company B. On the other hand, somebody else who's really concerned about environmental stuff, much more than anything else, is obviously going to go for company A. So somehow you have to have something that will take that into account. So definitely, we obviously, for this audience, don't really need to run through the whole CAPM again, but just remember, because we're going to branch out from this, you're maximizing your expected return, which is the weight in the risk-free asset, plus the weights in the riskless assets times the expected return, minus some risk aversion coefficient times variance of the portfolio, subject to a budget constraint. And usual thing, you write down the Lagrangian, take the first order conditions, clear the market, separation theorem, and voila, out drops capitalizing pricing model. Right. For other audiences, I go through that one more slowly.
I just want to put in a plug for Jack Traynor. I can send you his 1962
yes,
paper.
actually, yes. Jack Traynor was definitely a pioneer in this area.
Some say he got not out of the Nobel Prize.
That's...
It's one of those discussions. But
yeah, well, you know, Fisher Black didn't get the Nobel Prize either because they judiciously waited until he died before.
Well, yes, that's a different,
so different reasons, different stories, but of course Nobel Prizes are political.
Well, but his paper was cited for the Nobel Prize, so I think he was more lauded than Jack Traynor was in that.
Oh, you mean Fisher Black?
Yeah. He had the misfortune to die before.
Well, I think they waited actually until he died. They didn't want to, from what I've heard, they didn't want to award a Nobel Prize in economics to Fisher Black.
Well, they certainly then didn't want to award one to Myron Scholes. I mean, if they didn't want to award one to Fisher Black, this is a logical consequence. But anyway.
I would say the first time I met the two of them was when I was at Wells, and after I met both of them, I thought, how did these two ever manage to write a paper together?
Oh, that's an interesting comment. I never heard that.
These two guys working together, I don't see it, you know. But, I mean, very different personalities.
Yeah.
Anyway, so everybody's all familiar with CAPM. And the reason it was rejected when Bill Sharp first submitted it was because of the assumption of homogeneous expectations. All investors agree on E, and all investors agree on C, the covariance matrix. And the referee said, that's a ridiculous assumption, and rejected it. I wonder how it feels to be a referee who rejects a paper that then goes on to win its author Nobel Prize.
I know somebody whose kid was an early Facebook programmer at Harvard with Zuckerberg, and he advised his kid to get out, continue with his Harvard education, and not muck around with that. So I know.
Okay.
George Akerlof's Levin's paper was rejected several times.
Oh, yeah. There's a lot of good stories like this.
Yeah.
I think you experience what they call regret.
Well, Black Scholes ended up publishing in the Journal of Political Economy because none of the mainstream financial journals would accept it. You know, so hey, just because you get rejected doesn't mean that what you've done isn't worth anything. So the CAPM will go through more or less fine if you have heterogeneous expectations. If you replace E and C by E of K and C of K, that is per investor K, you can go through the derivation, it's just that it doesn't all nicely collapse, and what you end up with is a kind of market consensus for E and a market consensus for C, where the weights are messy, they depend on investor wealths and investor risk aversions, and it can be done, it just doesn't have that really nice form. So for this purpose, we're going to exploit a version that has heterogeneous E, but still has everybody agreeing on C, right? And you could relax that, but it's just, we just want to get to a kind of a result, and if everybody agreeing on the covariance matrix was good enough for Sharp et al., then let's go with it. So there's a version by Gerber and Hentz, and we borrowed that mostly because it's sort of a simple derivation and like notation and all of that. But I mean, people began working on this, I guess, as soon as CAPM was published. I imagine people started saying, well, what if we don't have homogeneous expectations? So what you get there is you get these weights which are people's risk-adjusted relative wealth. So it's not just the percentage of the economy represented by my wealth, but it has to be factored by the risk aversion, because if you're more risk averse, you're anyway going to put less money into risky assets, right? So in some sense, you could say this is your wealth, the amount of your wealth that you're going to put into risky assets rather than riskless asset. That's how much importance you get in determining these consensus numbers. So if you define these weights like that, then consensus E is just the weighted average of everybody's individual E's, right? And if everybody agrees on that, then of course E just comes out and the sum of the A's is 1, and so you just get the expectation, okay? And then you can do something similar here. You take the percentage of wealth related to risky assets, and you get this thing here. So you define the weights of all investors' risky portfolios, and you can define the market portfolio in a very similar way. So it's just a weighted average of everybody's weights, which is sort of obvious. I mean, that's what the market portfolio is, it's just everybody's weights, but you have to adjust for wealth and how much of that wealth is in risky assets. And so you can define the expected return on the market, a consensus version of that, as this consensus E together with these total market weights. Right? And then your security market line looks very much like the standard one from regular CAPM, except instead of the vector, we have, you have a consensus of all the E's, and then instead of the market portfolio, you have the consensus of that consensus market portfolio. Note, however, that beta is just the same beta. It's just the beta. There's no consensus going on there, and that's because we assume that everybody agrees on the covariance matrix. So if you had heterogeneity with respect to the covariance matrix, then this thing also becomes much messier and so on. But for our purposes, we don't need that. We're really just interested in having heterogeneous E's, and by assuming that everybody agrees on the covariance matrix, we can keep beta nice and clean. So now we're going to set up the individual investor's investment problem, and we're going to assume that his total return is the return that he gets from the risk-free asset times whatever weight he puts in that. And then for the risky assets, we'll assume that from every risky asset, he earns a combination of returns, a weighted average return of his financial return, R, and his social expected return, S. Social return. We haven't got to expectations yet. Now, so we haven't yet got to talk about how do you even tell what S was after the fact? I mean, predicting expectations and covariances and all that is hard, but at least after the fact, the end of the month, end of the quarter, you can look back and say, okay, my return was 3.49%. For some assets. For some assets, actually, you can't even say that. I mean, private equity investments, real estate, non-liquid assets, real assets, you bought into a forest. What did you make over the last year? That's not really clear. And for social return, it's definitely not clear. I mean, if you invested in a company that you think is going to put up 1,000 wind generators, right? So how do you measure the return on that?
How do you combine them? Don't you have a problem with units?
Well, I mean, of course, that could just come back to a definition of what phi is. I mean, we know what the units of R are. You can always worry about the units of S, but if somebody said, oh, gee, my units of S are different from yours, mine are double yours, for whatever reason, you can say, well, fine, we'll just change phi.
I see. So phi converts my happiness of saving the world into a dollar amount?
Yeah, you can think of it as that way. I mean, if you look at phi over 1 minus phi, that would be a marginal rate of substitution between social return and financial return. But obviously, if you're going to start trading one off the other, you have to be able to convert units of social return into units of financial return, or there's no way of combining them and trading one off against the other.
I'm sorry, if you scale phi k, doesn't the 1 minus phi k dot r term also change and in an unpredictable way because it's affine?
Well, I mean, if you don't know what phi is, right? In fact, nobody knows what his phi is, nobody knows what his risk aversion is, nobody knows any of these things. But I mean, the idea here is just to say that I've got some way of defining units of social return, and I just want to combine these in some way. Now, the fact that I've made them here add up to 1 is actually an unnecessary restriction, and what we found in practice is it's much easier not to do that. Because if you start increasing, you'll see that this is going to come up again in a slightly different context, but if you start playing around with those numbers and you require that these sum to 1, maybe you have to change one thing when you change another, and it's sometimes easier not to do that, just to kind of move things and then worry about scaling at the end. But we'll see that that's just about to rear its ugly head yet again. So if this is the objective function, then we're going to make the standard assumption that what investors care about is the variance adjusted expectation of this quantity. Same kind of thing as cap M, right? Except that now variance and expectation are taken with respect to this beast, which includes S. So how are we going to model this S? So we saw before that we had these different aspects of social return: environment, poverty, what they call basic pyramid, women on boards, education, etc. And so we said, okay, let's assume that we've got in the economy L different social metrics, okay? And we'll assume that, so each one of my N assets is going to have returns in each of these L dimensions. And for that, I need to have some matrix, which we call V, of the expected social return from that metric for that asset. So if you thought it was, a hard enough problem coming up with the expected return forecast for assets, we've now made the problem, an order of magnitude bigger. You've now got to come up with this N by L matrix V. The only good news I can say on that front is, first of all, that matrix might well be quite sparse, which makes the problem a little bit easier. So there'll be many firms where, if they're producing any social return at all, it's really only just on 1 or 2 metrics. Okay, so maybe a lot of these numbers are just 0. The only other good news is that there are firms out there which are in the business of doing this, just like you have firms that forecast stock expected financial returns. Now increasingly you're seeing people say, well, gee, maybe we ought to be in the business of trying to forecast social returns in these various metrics. So it's the kind of thing where you may not have to do it yourself. You might just say, I'll accept somebody else's forecast of this, and then I will just deal with the problem of how to build my portfolio optimally to reflect that. Okay. In financial returns, of course, you could just put your money in an index fund, or you could be an alpha predictor and say, no, I can come up with a forecast of expected returns better than everybody else. That's why you should give me your money, and I will charge you exorbitant fees because I'm so good at that. And maybe you'll have the same thing with social return. But I think I'll come back in a minute to why that might be the case. So then we said, okay, so you've got this N by L matrix of expected social returns for every asset for each of these L metrics. And then we'll assume that every investor has a preference vector P. Okay? And this preference vector is a vector of weights that sum to 1, where it's essentially how he wants to take the expected returns for all these different L metrics and combine them to get his total social return. So while phi tells you how enthusiastic he is about social return rather than financial return, right? P tells you how much he likes one metric versus another metric.
Can these phi's be negative? Like if I'm going around buying up tobacco stock?
We haven't really thought about that, but we've discussed that internally. Yeah, there's a class of investors that, you might call them financial-only investors, to use a term of art from economics, that's investors who don't give a shit. But you could imagine that there are people who just say, to hell with all this, colony of women in board, I'm just going to buy all the Exxon stock I can. But I mean, it's more likely to be that they just don't care rather than they actually have some reason to hate it.
Well, they're like trolls, thinking, well, there's all of this growing pot of socially responsible investors, so there's less demand for these sin stocks. And yes, we're going to come on to that towards the end of the paper. But then they would be doing that because of what they perceive as higher financial return, not because they actively hate social return. Yeah.
So I would think that Koch brothers probably hate social return.
No, I don't think they hate it.
Their Pioneer Fund needs a good name.
The problem with the Koch brothers, it is all the fault of one individual in American society, and that is Upton Sinclair. It's all his fault.
Oh, I didn't realize we had someone to blame like that.
Yes, Upton Sinclair once wrote, it is very difficult to get a man to understand something if his salary depends upon his not understanding.
I thought we had Ayn Rand to blame.
Oh, we can blame her too, yes.
So there's two.
Their love child.
Okay.
But yeah, I mean, look, the Koch brothers own enormous amounts of fossil fuels, and any admission that that might have negative social consequences is, you know, their salary depends upon them not understanding this.
Okay, well, we'll give them the benefit of the
Right.
doubt.
And you know, they have to not understand it. The reason they have not to understand it is because if they understood it, then they'd be living with this
Dissonance.
cognitive dissonance, and nobody likes that. So to get out of that, you just convince yourself that there's something really true, and then you're fine, right?
Fortunately, we are very skilled in that area.
Yes, we are very skilled. Right. So to get back to this p-vector, one of the things we found in actual implementation, rather than requiring the investor to say, give me a vector of weights that sum to 1, we think of it more like, you know, a soundboard where you've got all these sliders on for the gain on different channels, and you say, well, I want to push that one up a bit. Give me more gain on the guitar, right? And push that one up a bit. And so you just kind of come up with these sliders. At the end, you can just normalize them so they sum to 1. That might cause you to have to change your phi, right? Which also might have to cause you to change your lambda. But I mean, investors can get their heads around that more easily than saying, look, here are 100 points, allocate them to these different social metrics. You can do that, it's a little harder for investors.
So, going back to your example, you had this one with like third world poverty or wind turbines.
Right.
So V would represent maybe a company, a column is wind turbine count.
Right.
And so it just counts the number of wind turbines.
Well, how do you measure the return on that?
Well, right, and so then the P is then, I come in and I essentially put like some kind of price on how every additional wind turbine has a value to me.
No, you're just saying how much do I like, you know, alternative energy social impact versus base of pyramid.
But that's what the P is.
That's what the P is, yeah.
So the V is quantifying how many turbines, and the P is sort of
to some extent, I mean, probably where you have to quantify that is where you convert number of turbines into S, into units of social return. That's probably where you have to go through that exercise. And depending on how you do that, I mean, you could say, and the way Athena's approaching this is to say, we're going to try to make the units of S comparable to, say, something like private equity, and so we will normalize returns in the social metrics to be between -20 and +20%. Right? Not between -100 and +100, because then it becomes very incomparable to financial returns. But if they're in that range, it's sort of roughly order of magnitude comparable to the kinds of numbers you see for financial returns. Okay. So one way or another, you have to kind of tease out from an investor what his P is. But I think that's easier for investors to do than if you just say, so what's your phi? What's your lambda? I mean, if you go to a mean variance investor and say, what's your lambda? I say, I don't know what you're talking about, I don't know. And the way you get there usually is you show them a bunch of different portfolios and they'll say, no, stop, that's the one I like, right? And from that, you say, okay, so you want to be here on the efficient frontier, so that means your lambda or your risk tolerance is X. We'll remember that for next time, right? Not that investors will ever be consistent from time to time, heaven forbid, but hey. So the expected social return then is going to be the matrix of V times P. Okay, just take that expectation of along all the different metrics, multiply it by an investor's P vector, and that gives you the expected social return for that investor. Okay, so now we can write the expected return, the expected total return, like this. Okay, everybody agrees on E, right? Everybody agrees on risk-free rate. People have different phis, people have different Ps, and people agree on V. So we are into heterogeneous expectations land here.
Shouldn't we have a K on the left side of the equation?
Yeah, actually we should. Yeah.
Okay, that's all right.
We can type it. Yes, this is per investor K. So the expectations part is relatively easy. I mean, yes, you've got the burden of figuring out what V is, but maybe you can get that from a third party. You have to sit down with your investor and say, so let's tease out your P vector, let's tease out your phi, and anyway, we're going to have to tease out your lambda. Maybe the way we'll do it is we'll show you a kind of an efficient frontier as we vary risk aversion and social enthusiasm, and you'll find the point that you like, something like that. Okay, now we've got the quadratic term. Quadratic term. Well, so because it's a sum, we just write down the variance from the formula, and you get that. And the good news is that the first term that's fine. That's the usual thing we have in Cap N. Not that any of us really know what the covariance matrix is for all assets for financial returns, but we always like to pretend we do. What are we going to do about the other two terms? Okay, the first thing I'm going to do is to get rid of the middle term by claiming that covariance between social and financial returns is 0. That's my null hypothesis, and I challenge any of you to reject that null hypothesis. Good luck. I mean, you can come up with arguments sort of why it might be positive, why it might be negative, you know. If you do well by doing good, then maybe more social return is going to get you more financial return. But you could say, you know, we're going to make more money by contributing less money to those windmill projects in Africa, right? So you've made more financial money, but you've lost social return. You could make arguments both ways, but you also never be able to measure it. I mean, it's hard enough measuring the covariances or predicting the covariances of financial returns between assets. So now you want to get the covariance between R and S, not a chance. So therefore it's 0, we do it with hand waving, and it's hard.
So there's a whole bunch of so-called scholars put up by these right-wing think tanks hired by the oil companies and stuff to say modern finance theory says when you cut down your universe of available securities, you know, excluding, you must be lowering your opportunity set. So I wonder if that can, I mean, you can take that or leave it, or get into an argument with them. But I wonder if that kind of thing can turn into an argument against your null hypothesis, that people who are not in the business of maximizing their financial returns, period, as Paul Samuelson says we're all supposed to, are leaving something on the table, and that there's some kind of feedback loop into an argument.
Possibly if there's a feedback loop, otherwise we'll come on to that when we get to the result.
Yeah.
I mean, you could probably argue it both ways. I mean, making the argument that by shrinking your universe, your ex-ante utility is going to go down,
Yeah.
if your utility is only financial, is reasonably compelling. It's sort of hard to refute that.
It's kind of a rational market.
What
Yeah,
about
I
the-
mean, if markets...
What about the
It can't
two
go
funds?
up, but it
No,
doesn't
I mean-
necessarily have to go down. You know, it could make some difference.
Well, you're going to have, you're going to have a bit more risk as well as more diversified.
Not necessarily. I mean, so for one thing, you can do a lot with tracking portfolios.
With what?
Tracking portfolios, so that you
Yeah.
don't just exclude things, but you.
Right, and you change your weights and so on, but I mean, ultimately, if I gave you two problems and I just said this one has a sub-universe of that one,
Yeah.
and you ran optimizations, you're going to end up with a smaller, if you shrink the feasible set.
You know it can't be weakly
Right.
embedded. That's what the.
Right.
Firm says it can't be. It can't be.
Your utility can't go up. If you
It
shrink,
can't go
if
up.
you shrink the feasible set,
Your utility can't go up.
it can't go up.
It doesn't say it goes
It
down.
doesn't have to go down.
Yeah.
But in all likelihood, it probably does, or maybe it's not measurable. But we're going to come back to this question in spades once we've got the result. Okay. So the good news is we've managed to get rid of that middle term. What about that last term, variance of S? Okay. Well, let's see. I'm going to get rid of it by following hand waving. So we could certainly write that the variance of S is kappa times the variance of R plus some error term. That just defines that error term omega. All right. And I could also suggest that your disutility of risk, lambda times the variance of R, could actually be broken down into an aversion to financial variance and separately an aversion to social variance. Now, Bar Rosenberg actually did this trick back in the 70s with a factor model approach. He said you've got variance due to factors and variance due to idiosyncratic risk, right? And he said there's no reason why your aversion to those should necessarily be the same. If you were a manager and you said, I think I can, I've got alpha, I can predict stuff that is due to idiosyncratic return, not factor related, but idiosyncratic things in stocks, you would be willing to take idiosyncratic risk, but you perhaps would not be willing to take any factor risk at all because you perceive there's no reward to it, right? So as a practical matter, you might just say, I am somewhat averse to idiosyncratic variance, but very averse to factor variance. Similar kind of thing here. You might say, I've got one aversion to financial risk and a different aversion to social risk. There's an argument why I think it's true, which is that the risk of loss, any loss in your portfolio, financial, is entirely borne by you. Okay? If there's a loss or returning lower than expectation in social return, that's not borne by you, it's socialized, everybody bears it. You thought they were going to put up 1,000 wind stations, they only put up 500. Did you lose anything personally? No, not really. The planet loses, if you like. So, because, yeah.
But isn't that really the same argument about why people would do this in the first place, is that they want to make the planet?
Well, they do. They do.
So
I mean, they want the expectation of social return, but, you know, if you say, I don't know, they aim to put up 1,000, but it could be 500, it could be 1,500, it's kind of risky. They might just say, well, okay, it's risky, but, you know, in expectation it's going to be 1,000, and that's pretty good, and okay, it might fall short, but it might also be much higher. I can live with that. Whereas if you said the same thing about their financial return, they might go, oh, you mean I might only end up with this much money when I retire? I don't know, like that. So I really do think that, you know, whether it's sort of moral or not, I just think that people are generally less sensitive to the risk in social return than risk in financial return.
So what about the variance in the average average warming over the next 100 years? I don't have children, but suppose I had children and grandchildren. You think I don't care about that?
Well, I mean, yes. What we care about, I mean, but there you could say what's bothering you there is the expectation term, not the variance, right? We've got this expectation of some nasty negative stuff, and we really don't like that. Okay? It's not that it might be a little faster or a little slower than we thought. It's the fact that we're on this downward trajectory, and that sucks, right? So, I don't know. I mean, look, these things are all incredibly hard to measure, but I'm going to speculate that lambda 2 is perhaps a lot smaller than lambda 1. So, rewriting that, I can write this like this, where I have one term with variance of r, which now combines both the first term from variance of s, involving lambda 2, and then I've got this thing at the end, which is lambda 2 times omega. Okay? And now I can ignore that last term on one of two grounds. Either that lambda 2 is so small, or that omega is so small. Okay? Supposing omega was 0, that would mean that the variance of s is just a multiplier of the variance of r. Is that a reasonable thing to say? There's another highly respected model in finance where they make an exactly analogous assumption. Anybody know what it is? It's Black-Litton. Okay? They have the variance of returns, sigma, whatever. And then they say, well, we don't know the true expectation. We have an unbiased forecast of that, but there's estimation of variance. What does that covariance matrix look like? They assume it's just some scale multiple of variance of true returns. Why? Because it's nice and tractable, and hey, who can reject that one hypothesis? So, but I can get there either because omega is small, or even if omega is not so small, I can get there if lambda 2 is small. So, between one of those two, I feel fairly safe to say I can get rid of that term, and now I can just say that the disutility of total variance is actually just something, is just disutility of financial variance if I suitably scale the risk reduction parameter, which I anyway don't know, so therefore what's wrong with changing it a bit. So by doing that trick, I've managed to get rid of those two other nasty terms in the quadratic term, and now I can get back to here where I've got this objective function, right? There's the extra term that we got in the linear term from the social return, which is per investor. And then we've got this term over here, which is actually the same for all investors because everybody agrees on C, and we got rid of the variance of social return. And so now we can say, oh, well, that's the same as the heterogeneous expectations version of CAP-M, which is in Gerber and Henson, so we can just plug everything in. off we go, right? And so what you get is that the consensus E is going to be E times 1 minus consensus phi, where the consensusing is done with those weights A that we saw previously. And then you've got V times consensus phi P. Remember, phi depends on the investor and P also depends on the investor. So you have to take phi and P together and then consensusize the product of them. Okay? If you just do the math, it's fairly true. Okay? So what we get is that E times 1 minus consensus phi plus V times consensus phi P minus the risk-free rate is that. And again, remember, beta is constant because everybody agrees on the covariance matrix. So that's basically cap n, but extended to include social return, making a bunch of assumptions all the way. One of the implications of this is that, all else equal, if an asset has a higher social expected return, it will have a lower expected financial return. Because that left-hand side just has to be the right-hand side. So if you increase one somehow, you've got to decrease the other. Now, there's been this long simmering argument going on in the whole social finance space. People will say, no, you don't have to give up financial return. It's an expectation. You don't have to give up financial return to get social return because you can do well by doing good and blah, blah, blah. This said, actually, no, that's not true. That's not true. Why is it not true? Well, there's a clientele effect here. And the clientele effect is exactly analogous to what you have with munis, which we all know a lot and understand. Okay? What's the deal with munis? Some investors just get the return on their munis. Some investors get a check from somewhere else, the taxman. Right? Because if you're a taxable investor, the taxman says, I'll let you out a check, here you go. Right? But if you're tax exempt, you don't get that check. So if munis are priced low, the investors will bid up the price, and then there'll come a point where the tax-exempt investor says, look, if the price keeps going up and the expected return goes down, I'm not interested, not attractive enough. The taxable investor says, I'm still happy, I'm going to keep pushing the price up because I get this check from the taxman. It's still attractive to me. And as a result, you get a pricing such that tax-exempt don't invest in munis. And taxable guys do because they are rewarded from some other place. Here you've got the same kind of thing going on. You've got your financial-only investors who at some point they'll say, you know what, if the price goes up, expected return goes down, not interested, doesn't look good enough for me. The socially enthusiastic investors will say, oh, no, I get a check from somewhere else. I get social return, which is important to me. Okay, I like that. And so it's like getting a check back from the taxman. And so they'll continue to push that price up, and you'll get a clientele effect.
Well, that's just heterogeneity.
Yeah. But I mean, you'll get this very clear thing between financial-only investors and socially enthusiastic investors. And it's very much like munis. And so, and this model just confirms that. It says, yes, that's exactly what you're going to get. So then people will come out and say, no, but you see, there are all these empirical studies, and they show that when you invest to get social impact, you don't have to give up financial return. My first problem with that is a linguistic problem, which is they're using the present tense. Now, the present is a nanosecond long. There's the past, and there's the future. And when they do these empirical studies, what they meant is, if you had invested in the past like this, ex post, we can say that you would not have had to give up financial return to get social return. But it doesn't do anybody any good. We care about the future. And when you use the present tense in English, we generally reserve that for expressing a kind of an intrinsic property of something. You know, I have grey hair. I had it last year, I'm going to have it next year. Well, I suppose I will. But but it's not an intrinsic property of social impact investing that you kind of, in its nature, get the same financial return. Okay? Yes, in the past you may have, and as you know, markets of course may be inefficient. All this is efficient markets, and I'm the last person to claim that markets are efficient. Well, not the last. There are probably people behind me. But you know, and the good news is, by the way, if markets are not in equilibrium, but they're going to trend towards equilibrium over the next decade, get ahead of it. You now have a chance to get ahead of it, and as the price of socially enthusiastic or high social expected return investments, as those prices begin to rise, as they get pushed up by socially conscious investors, if you got in there first, you'll enjoy that price rise. right? But this is just a model about what things should be like in equilibrium. And in equilibrium, you should have this clientele effect between people who don't give a shit and socially enthusiastic investors. Okay? So,
Do the stranded asset people get in here too? I'm smarter than the market people. Do they have a role in your theory? And also it's kind of, I mean, they could also be the ones to say, well, I really don't care if they're stranded assets or not, but I believe more people will be enthusiastic because they'll have grandchildren. Hence, they'll, for whatever reason, they think those prices are going to go off of today. They have some view on
yeah, but see, now you're talking about the process by which we get from a non-equilibrium state to an equilibrium state.
Yeah, I am.
Right.
You brought it up.
Yeah, well, this model, of course, is silent on that. It just says, in equilibrium, under all those amazing assumptions, this is what you should see, right? But how we'll get from here to there, I mean, we'll never get there. It's like one of those things that you sort of get close, but you never
And it
quite
runs
get
away.
there, and it's always everything's shifting around. And
Well, the model really assumes everything's in equilibrium, and so it's basically assuming that people have the same beliefs about returns, right? So, you know, everybody agrees on whether assets are stranded or not.
Right.
And in fact, that's basically a regulatory question.
right. Well, I mean, it's the problem of assuming that everybody agrees on E,
Yeah.
which in real life we know they don't. And yet we know that CAP-M was sort of, it turned out to be a pretty good model, even in the face of that assumption, which caused it to be rejected. It's like all models. I mean, you use them to try to gain some insight into how things work. Nobody claims that this is a true representation of reality.
Well, if I wanted to make a counter argument, I would say that expectations of social return are really associated with an underlying attribute of a higher future economic return, because eventually there will be a carbon tax.
Right.
And all of these alternative energy companies are going to start making tremendous financial returns disproportionate to
But is that just an argument for claiming that R and S are actually positively correlated?
Yes,
Right.
yes, that's exactly what
Yeah,
it is.
I mean, I acknowledge that my assumption there of zero correlation is it's just an assumption, and you can make arguments in either direction, I think. But again, what makes these assumptions partly because one wants to keep within the realm of tractability. And you know, then after you get there, you can say, well, let's see, could we go back and relax this assumption? What happens if I go back and I try to model that correlation between R and S? Could I do so in a way that still gets me something reasonable?
Well, I guess my only motivation for that is that there seems a more naive narrative for the clientele effect. If you start with a market which is at equilibrium, when no one derives utility from social return, and then you add a new cohort which derives utility, of course the prices are going to change.
Right.
In an inevitable way, which will penalize the returns on the assets that offer this new, this attractive feature to this new cohort.
Right.
Right.
Yeah, I mean, there's all interesting things to pursue. I think the trick is even just to start getting investors to be able to think about this and actually have it somehow impact their actual real investment portfolios, which is, you know, the Zets issue. So another reason why they may not have seen social impact in having in the past affected financial returns is, you know, the size of the impact investing market is so tiny still. So even if it were having an effect, its magnitude would probably be too small to be measurable. It's very hard to measure social returns. We've already talked about, you know, what is S, what's expectation of S, how do you measure it. There's also this short-term versus long-term, and in CAP-M, and therefore by extension this model, it's a single period model. That's it, right? You start, you end, game over. In reality, you've got investors who, you know, some investors might be saying, all I care about is what am I going to get next quarter or next year. And next quarter is a very common one, unfortunately. Whereas the socially enthusiastic investors might really have their eye on the long term. So these are reasons why maybe, you know, things haven't yet shown up in all these studies that people have have done, but I mean, these studies are all backward looking, and I really question how valuable they are to say anything about the future, and I view them as perhaps a lot of marketing by firms or individuals that have an axe to grind. So in real life, how is Athena working with its clients? So generally they start out with an investor, you sit down, a new client comes along and says, all right, let's get your investment policy statement. What kinds of risk tolerances do you have? What requirements do you have? Do you have cash flow requirements? What's your tax status? What kind of constraints do you have? Oh, you have a big portfolio separately over there, which is all private equity. Okay, so we shouldn't include any private equity. Got it, right. So these are all the kind of things that you have to ascertain when you sit down with your client. You develop capital market expectations, and the client probably isn't terribly involved in that. I mean, what's the client know? I mean, I suppose there are clients who say, oh no, I made my money in finance and I have some very strong opinions about this. But if you made your money in shipping, you're really going to have opinions about most asset classes, probably not. But then you also have to be able to come up with the capital market expectations for social return. And so in Athena's case, they're not trying to do this completely independently. What they like to do is to be able to get this from other sources and then maybe just tweak it themselves a little bit from their own research, but not just say, I'm ignoring what everybody else is doing. We're going to have a whole team of researchers going out visiting forests and that's a full-time activity. And then you do your asset allocation, taking into account the investment policy statement. And then, once you think you know how much you want in the various asset, sub-asset classes, then you have to look within sub-asset classes, look for managers, maybe it's index funds, maybe it's active managers, etc. And then you monitor and report back, and you have this kind of constant circle going along with your clients. So, in terms of getting people's risk aversion, typically what they do at Athena is they try to divide people into 5 risk buckets, and then work with the client to say, okay, which risk bucket are you in? Okay. That's not the only way of doing this. I mean, you could just try by showing an investor many portfolios, you could just try to say, we'll figure out an actual value of Lambda for you. But if you want to have commingled portfolios where you can say, a bunch of clients can go into this and a bunch of clients can go into that, you have to be able to group them in some way. And so having different buckets like that for risk metrics is actually not a bad thing to do. Now, once you start bringing social impact into it, things get a little bit messier. So financial-only investors, aka people who don't give a shit, their phi is 0, right? And they're going to have a certain risk-adjusted expected return. When you start making phi a little bit positive, and you alluded to this earlier, you may not, in fact, have to give up anything measurable in terms of your financial expected return. But as phi begins to get bigger and bigger, you're going to begin to drop down on that risk-adjusted financial expected return because you're getting your reward somewhere else. Then you have to sit with your clients and say, okay, somehow we need to figure out what your p-vector is. So here's an example with using dollars, and I say, well, there are 5 of these metrics. Somebody might say, I'm going to put $50 in that one, 10 in that one, 10 in that one, 30 in that one, and none in that one. As I said, we've kind of moved away from that a little bit and using more of this sort of sliders on a soundboard kind of model. But it sort of doesn't really matter. You can get there for any which way you like. So then, when it comes to actually picking investments, you've got to get this V matrix before you can do that. And so there are off-the-shelf industry ones, which I mentioned earlier. These are some of the people doing that. I suspect there might be more by now, I'm not sure. But MSCI have their ratings, and Sustainalytics, got a cute name, and, So there's more and more of this stuff now you'll be able to get.
Have you tried SASB? Do you have any opinion about those guys?
I don't know.
Sustainable something,
Yeah,
they're trying to be like
accounting
GASB or
standard, like
FASB.
GASB, yeah.
So they're trying to be very non-profitish and
I don't know, yeah.
become the industry standard. And
But this landscape is actually changing fairly quickly, so
Yeah.
this might look very different than it did 2 years ago, and it might look very different 2 years from now.
MSCI all over the place. Like I get
Yeah.
3 emails from them a day about this thing.
Yeah.
But I don't know.
3 years.
Yeah, I mean, I just got 2 this morning. I mean, they're really
Yeah.
pushing out
All
there.
right. And I probably don't need to work through all this. You've got V times P, and everyone knows how to do that kind of metrics calculation. So yeah, you get V, you get P, you multiply this matrix and effects and calculations. And then you have, by taking their enthusiasm phi, which you have to back into somehow, and their preference vector, you can actually, you can kind of compute a social Sharpe ratio. It looks like a regular Sharpe ratio, except instead of having ex ante expected return or ex post average return, you substitute in this weighted average between financial and social return. Again, after the fact, ex post, there's still the issue of how you determine what you actually earned in the social sphere. But interestingly, from Athena's experience, and this is what I understood from them, investors don't care all that much about that, right? What they want to know is that I think I'm going to do good here, and that's how I want to invest. But at the end of the day, if you said, well, should we look and see how much social return you actually got from that? It's like, that just doesn't seem to be such an issue.
And are they okay if their financial return is lower? Let's
Some are,
suppose you
some
set that
aren't.
thing to 0.
Yeah, I mean, some are and some aren't. Some people, they're what they tend to call financial first investors. So financial first investors are people who say, I want the highest expected financial return possible, and if I can get some social return without damaging that, I'm happy to do that. I'll certainly use social return as a tiebreaker, right? But I don't really want to give up anything measurable in financial return. So those we call financial first investors, not financial only, but financial first. And then you have, sort of moderate social enthusiasm. Then when you get all the way to the other extreme, where 5 to 1, that's essentially philanthropy. You say, I just want to put my money out to make the maximum social good I can, and if I have to earn a buck or two over here, great, but I don't really care.
So this relates a little bit to your earlier point about not caring that much downside risk with respect to social return. One way to say it is people care mostly about trying to do good.
Yes.
If they fail, well, they tried.
Yeah.
No one cares only about trying to get a good return.
That's right,
They
because it
don't
affects
say,
you.
oh, I lost half my money, but I had to really try. Isn't that terrific?
because the loss of natural return is
Dear, great news. We tried to get a 50% return this year.
I have come across hedge fund letters.
I know, exactly.
I'm going to say that. Good news, we tried. Bad news, we lost half the money. But it's look, trying to do social good. And you say, okay, maybe they're not going to be able to alleviate poverty the way we thought. It's a hard thing to do, right? We made mistakes. We thought these things would have an effect. It didn't lift them out of poverty the way we thought. Unintended consequences.
In fact, it's quite the opposite. We tried.
Well, but then it leads you to say, all right, that didn't really work out, but at least I've learned something, and now I can change tack and try again, right?
Or go to the Ritz-Carlton because I deserve it.
No, I haven't come across that one.
Oh, okay. Well, I think actually people do. I've certainly come across it. They kind of tried and then they pat themselves on the back and reward
And then,
themselves.
so it didn't work out, but I'll go to Davos anyway.
Yeah.
Right, perhaps. Yeah, but I mean that's where we get into there is a very different attitude towards reward and risk when it comes to social return to financial return. And partly it's the nature of the beast, partly is because in financial return it's generally privatized, and in social return it's socially owned.
See, I wonder if there's something worth looking at in not-profit corporations versus for-profit corporations, or volunteer supported efforts versus paid employees, where you have very different expectations.
Yeah.
Like, you're working with volunteers, you're delighted if they show up at all.
Right. Right.
And not so, that guy.
Yeah. I mean, this whole thing, you have to bear in mind, this is all a pretty new field. I mean, yes, we did have things like, funds even from the 1920s excluding alcohol and tobacco, and then South Africa in the 1980s and so on. So it's not that this is completely new, but back then it was really just much more ad hoc. And there's some obvious villains, and we want to get those out of the portfolio. And arguably, you could say, just doing that, it's the 90-10 rule. You get 90% of the way there just by those kind of simple screens.
South Africa's a special case because the main thing that happened was not that portfolios sold stocks of companies, it's the companies pulled out of South Africa. So when UC divested and did it over 3 years, and it actually only sold a tiny amount of stock.
Right.
You know, each year, they had to reduce it by a third, and each year, a third of their affected holdings or more, the companies pulled out of South Africa, and so no stock was sold.
Right.
That, doesn't that complicate looking at historical returns over that period?
Yes, it probably does, and if you don't account for those things properly, you get very you really have to go back and look at the composition of portfolios and what was the interaction effect between companies pulling out and how it affected your portfolio. But anyway, you know, that social impact market has been historically so small. I just think all those empirical papers are, you know, not worth the paper they're written on. You just can't really tell anything historically because it just hasn't been around long enough, you know. And then, you know, of course, some people would say, well, if the threat of excluding you is enough to get you to do the right thing, that's great too. We can kind of achieve our purpose that way. And then, yes, it won't show up in poorer returns, you know, of your price getting driven down by socially conscious investors. So the whole thing is kind of, there are a lot of moving parts. And with this paper, all we were trying to do, well, you know, when Lizette showed me their approach of having these L metrics and then investors having these allocations through this vector P, I looked at that and I said, oh, we can extend capital asset pricing model using the heterogeneous expectations version. Let's do that because it's a nice way of extending CAP-M to kind of incorporate some of this stuff. So partly we wrote the paper because I realized we could, but it seemed like an interesting enough result that it's you know, all fields are like that. You get lots and lots of little results, and each one of them is just a small piece, and eventually the body of research gets to the point where you can really begin to say something meaningful. So this is just another tiny little brick in the wall. It's not any kind of breakthrough, because all we were doing was leaning on the existing CAP-M, which was a breakthrough. But, you know, I do like the fact that it can tell you that, look, in perfect markets, in equilibrium, given all these assumptions, yes, you should expect this clientele effect. You should expect assets that produce social return that is valued by investors to have lower expected financial return. That's all. But not necessarily in equilibrium now, maybe will never be. The effect may be too small to measure. You know, maybe it's an aspect of social return that isn't sufficiently valued by investors who have high social enthusiasm, blah, blah, blah. But it also does give one a way of actually dealing with real clients. I mean, Evnine has real clients who are very concerned about what is the social impact of my investment going to be. And this is a way that you can say, well, we can actually incorporate that. We have we've got these L metrics, and we've got some real values for that V matrix that we can attach to that, and we can structure your portfolio to trade that off against financial return, and you know, maybe over lots of iterations we can kind of craft a portfolio where you'll be able to say, yeah, I get more ex-ante social impact and haven't given up too much expectation, I'm willing to live with that, it's important to me, etc., etc. And you know, that gets the client where the client wants to go.
Well, if you could firm up the model of the decreased return, the return decrement,
Yeah.
you could then make that a competitive selling point. On average, you should expect to lose this much, but we believe we can keep you within half of that.
Yeah, I mean, that's true. I think things would have to get a lot more developed and a lot more sort of, you have to put meaningful numbers on a lot more things perhaps before we get there. But, you know, maybe a decade or two from now, that's actually what we would do.
Well, the formula can set realistic expectations and help defend against whoever is saying, you don't have to give up any return.
Right, right.
We can then say,
Well, here's a model that says why that really can't be, so what's your argument against that?
right.
So then people would have to come up and say, oh, because, you know, I don't think that financial-only investors will use social metrics to determine whether they're going to get more financial alpha. Well, they're not stupid, why wouldn't they? Of course they. There was something I just saw recently on the internet, how people are looking at these social metrics to try to define financial alpha, to forecast financial alpha. Well, of course they're going to do that, right? So the financial-only investors pay attention to social metrics because they want to see, they don't care about the social return. But if it affects their financial return, they sure do care.
They want to find correlation.
Yeah. And you don't think the Koch brothers are worried about that? You've mentioned that name twice now. I think
They
that's
are,
the
they
legal
come
limit.
up a lot. They do. How much money does Athena manage?
Let's see,
Yeah.
in total, I think it's about 5 or 5.5 billion.
And how much of
But
it,
how much is in social impact investing? I don't know. I mean, I've had conversations about particular clients, but I don't know in aggregate at the whole firm level what it is right now. But it's a growing percentage, partly because they're trying to attract more and more clients who are interested in this because they think they have an edge over other wealth management firms.
and you're kind of thinking of this broadly as multi-asset class, right?
Yeah.
Because mostly when people say CAPM, they kind of technically mean multi-asset class and they don't talk about the S&P.
Yeah.
So, but
Yes.
you're really trying to do this
Yes.
in a
Look,
broad,
a lot of the
context.
social impact return that you get is going to come from private
from
assets.
private equity, right?
Private equity,
And-
private debt.
And natural resources.
Right, natural resources. So if you just start limiting it to listed equity securities,
Yeah, it's.
you can do it. I mean, and there are mutual funds that, just saying US stocks only, we're going to try to do this. But if you have investors who are investing in private equity and all the various asset classes, then you have much more
Much
opportunity.
more latitude, right?
I'm sorry, you said how big are their Fund 5?
It's about 5
Billion.
billion or so.
Billion.
Yeah. But I don't know what fraction of that is in various levels of
Uh-huh.
social. All right, I mean, all the rest is just sort of simple math that we can skip.
Well, right, do we have any more questions?
Well, thank you.
Thank you. We have permission to post this on the web? Oh, great, I'm gonna send it to you, is that?